Good evening, everyone. My name is Yogesh, and thank you so much for joining this session on trading strategies, where we will discuss about different kinds of trading strategies, not just market neutral, but strategies like seasonality patterns, strategies where we will talk about price action analysis, and a lot of other examples as well. Um, to make sure that if there is something which you find really important and you want to ask this as a question, you can use your chat options and keep writing in your notebooks if you feel that something is really important. There will be a one-on-one session also available to each one of you who is participating in this session. So, in case if you have any questions, you feel that you want to sit one-on-one, discuss, understand how the platform is used, or any of the strategies which I'm going to talk about, you're most welcome. Before I proceed and start this session, just want to understand if everybody can hear me properly, if you can see my presentation, if you can uh, hear me properly, you can use your chat options to send me a yes or a okay if I'm audible and visible to everyone. If you see my presentation, is everything is okay and clear to move on? Perfect. Okay, great. So I've started getting responses. So you can use this chat option to ask any questions if you want. We used to do a lot of seminars pre-pandemic, and I would still love to do these sessions in a very safe environment and a very sanitized and hygienic environment, taking all the safety precautions. But we are still taking our time just to ensure that everybody is safe. So till then, we'll be continuing to do these webinars, and the very purpose of these sessions is to, first of all, the most important purpose is to spread awareness about what's going on in financial markets with all different asset classes, how you can manage your risk, what are the strategies you can use at this point of time. That being said, all these strategies which are prepared by the researchers, they're based on what's going on right now and what is their expectation from the future. Um, Please do not take any of these uh, views and insights which I'm giving you as recommendations. Always and always talk to your risk experts before you enter into any trade or before you take any strategy. It's really important because probably what is a conservative risk from my end could be your very aggressive risk, right? At the end of the day, it depends upon every individual's risk appetite. So money is something which is very hard, and all of you work so hard to make money. So you need to understand the risk of every investment, and that's why whatever I'm going to discuss today, you don't have to blindly take trades over it. You have to just understand those strategies and then talk to your risk experts, talk to us, talk to your consultants, and only then look forward to do something like that. Now, today we are going to talk about trading strategies. Um, why it is really important to have a trading strategy is because we are living in a world which is full of volatility. Volatility basically means the ups and downs which happens in the prices. I'm going to use the chat options, and I request everybody to participate. Those who have joined this, um, name one stock which recently, it's a technology company, and it uh, crashed almost 25% few days ago, and that's the highest any tech stock has gone down in the history. Which stock it was? Can use your chat options to write the name. A technology stock which fell down almost 25% on one single day and was one of the biggest fall given the status of the company. Okay, use your chat options, guys. I know the webinars can be really boring because there is no uh, interaction live, but yeah. Okay, let me make it mostly, it's a US based company. I kept it very open. Paytm also fell down. It's not wrong, but Paytm not did not fell down recently. It's been a while, but yeah, Paytm also fell down. So a lot of you have started answering. I will give you one chance to even Google search and come back. I know it's a bit work, but then that's how you will get engaged into this session. It's going to be a wonderful session, guys, because these are strategies which uh, people don't normally, the consultants, they don't discuss it with you, but that's what the hedge fund managers and a lot of these people are doing. So, yeah, a lot of you have replied. Facebook, which is also now called as Metaverse. And I mean, it's ironic. Metaverse uh, actually had the worst fall. That was the headline in the Financial Times the very next day, that the Metaverse crashed in the worst way a technology stock can be. And it was due to poor results and poor earnings. And we saw stock falling down almost around 80, $82. And today, also, if you see, who's going to tell me the stock price of Facebook today? What's the current market price of Facebook? Anyone? Use the chat options, guys. What's the current price of Facebook? So, when you search something by yourself, it remains in your mind. So you retain that information. And you will realize that more you search, more it's in your mind that, okay, I searched Facebook stock price and how much it was. Anybody can answer the question, what's the current market price of Facebook stock? All right. Okay. 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 Perfect. Perfect. A lot of you have started searching. That is really good. That's all I wanted. You start searching yourself, and that is something which is really great. Okay. So yeah, if you see the current price, it's around 222 dollars. It has opened on a very lower side today, and we still continue to see Facebook like stocks, other tech stocks also, which are available. What is the current price of them? Because technology stocks are something which we have seen going down from some time. Now, let's try to understand how, during the current market volatility, and why market neutral strategy. First of all, what market neutral strategy is. Let's just understand what market has been going through, what has been, how much has been the fluctuation, and then we'll understand that why it is actually good to go market neutral. At this point of time, we are looking at different asset classes. If we look at stocks, if we look at oil, if we look at gold, there's a very mixed reaction which has been going on. So let's start, for example, with gold. Now, gold prices, they came down from their weekly highs of around, it was 1820, $1,821, but we saw dollar getting stronger, bond yields have gone up, so we have seen gold prices just slipping down. And again, when we see what is going on right now in the market, Central Bank of US has stated that they will be very aggressive in increasing the interest rates. What kind of interest rates I'm talking about? The lending rates. So basically, when you borrow money from the bank charges you interest rate. So US Central Bank wants to increase those interest rates so that the inflation can be controlled and the supply of money can be reduced. Now, that was one thing which made dollar really strong, higher inflation, and Central Bank of US continuing to talk about rate hikes. Uh, that pushed gold prices a bit down, but then there were renewed geopolitical tensions, resurfacing US China trade concerns. The Russia Ukraine crisis is going on. So that has again made dollar index go higher. At the same time, if we see the US inflation data, that also continues to increase. The inflation is expected to even go higher, somewhere around 7%. And that would be, if you compare from 1982, it's going to be the highest, right? So basically, if we look slightly a positive part around this, there is none. Because if you see COVID in Japan and Hong Kong, again, it's really, really challenging. Uh, Only on the charts, sometimes we see smaller rebounds for gold, somewhere around 1820, 1828. But then that being said, the negatives are way too much to understand this. So this is something which we need to know, that what's going on currently with the markets. This is really important. Um, okay, somebody said we cannot hear. Guys, sorry, I will be continuing to check my voice again and again, because you have to keep telling me if I lose signal or if I lose my connection. Can everybody hear me right now? Just write okay if you can hear me. Um, I just want to make sure that everybody can hear this. I have a lot of people right now, so I don't want to lose. Can everybody hear me properly? Okay, perfect, perfect, great, 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 great. Okay, just in case if you miss anything, there will be a recording of this webinar which will be uploaded, and you can always visit YouTube and see why we encourage live sessions, because you can ask your questions and whatever you like to. So we are still looking at gold prices in a range around 1828 or 30, but there is a lot of factors to talk about, whether it is rate hike, whether it is COVID issues in Asian markets, or the Russia-Ukraine tensions, or the US-China trade tensions. All these things combined are weighing on the markets, and that's why we have seen stock markets coming down. Most importantly, there is one sector which has fallen down a lot, and that is the technology sector. So the notion is that whenever there are rate hikes about to happen, or whenever there's a rate hike about to happen, the technology stocks come down because bond yields go up, and that makes tech stocks go under pressure because they have the pressure to outperform. Just see it in this way, that if I invest in a bond, I'll get a higher yield rather than taking risk and putting money in technology companies which we expect to grow in future. Every technology stock is Most of these technology stocks are known as growth stocks because we expect them to grow in the future. So whenever there is an environment where bond yields are going higher, central bank is raising rates, that makes investors switch from the technology stocks to the value companies. Now, what are these value companies? I'm talking about sectors which are defensive, non-cyclical. So I'm talking about energy, I'm talking about consumer utility, I'm talking about industrial, I'm talking about financials, right? So in a in a rate hike environment, that will be something which people would switch to rather than tech stocks, and that's why we have seen tech companies coming down. Now, I told you about gold. A lot of you must be very focused and a lot curious about what's going on with cryptos. Either whether you invest or not, everybody wants to know what's going on with the cryptocurrencies. And if we see right now, something really important is going on. Indirectly, if you want to gain exposure on the cryptos, not directly investing into the cryptocurrency, because we know how volatile cryptocurrencies are. But if you want an indirect gain in this particular space of cryptos, because there has been a certain bounce in Ethereum and Bitcoin, and it looks like a lot of investors are re-entering into the crypto area again. So look at companies, like look at specific companies or stocks which are related to crypto space. So companies like MicroStrategy, for example, MicroStrategy is down by 62% almost. From, if you see November 21, it was highest. Uh, January 22, during it was the lowest. It has come down almost 62%. If you look at Coinbase, it's almost down 50% from its high. So if the Bitcoin prices increase, there could be a possibility that a, a lot of investors, especially the high net worth in the basically what we call institutional investors, might again start entering, and this whole herd mentality can benefit these stocks as well. By the way, there is an ETF also, which is coming really soon, and that ETF is called the Valkyrie ETF, and it gives an investor the exposure to the Bitcoin mining firms. Now, again, it will be traded on Nasdaq. It will be coming really soon, and that particular fund will give investors exposure to the Bitcoin mining firms. Now that is again something really important thing to think about, that if you can't invest in cryptocurrencies due to any situation, can be the risk of volatility, or maybe it's your belief that you should not invest into cryptos, which is fine, by the way. If somebody comes to me and say that I want, this is my child's education fund, should I invest in cryptos? Absolutely not. By any chance, if you're looking forward for exposure in crypto space without investing into cryptocurrencies, look into the companies which are involved into it. Look at companies like Nvidia, look at companies like MicroStrategy or any kind of ETFs. Much less volatility, right? And you still get to have an exposure if this becomes something. Of course, as I said, that there has to be a proper diversification, not that you take all your money and put into one area, right? But a part of this can be put into it. Now, while we are talking about these asset classes, let's understand what a market neutral strategy is. Now, as the name suggests, so what has been going on so far? You see these big trading firms, or basically the hedge funds, they use a lot of market neutral portfolios. They don't do this directional trading. And directional trading is also something very common, because everybody has this very long term view, right? I talk to a lot of investors and they talk about these really long term views. Fund manager, they talk about buy this stock for a longer term. uh, but if you see hedge funds, more than directional, they are actually going market neutral, and it's been there for a while. And directional trading is very simple. So basically, investors like, say, you or me, any retail trader or an investor, even a professional day trader or a long term investor, what they normally do is they select a couple of stocks and they buy as per their view if they're expecting the prices to go up, or they start short selling if they're expecting prices to go down. Now, this is really simple. Whatever is the direction in their mind, they will buy and they will leave it. If they're expecting a decline, they will short sell and they will leave it. For a short term trader, it will be a minute's game. For a long term trader, probably is going to be a month or a year's game. But the strategy is very simple. Just predict a future direction and buy or short sell, leave the asset, right? Now, this kind of trading is called directional trading, right? Which we have always thought of doing it, or what we always think about. A lot of times, this trading is very profitable also. If a professional trader is doing it, sometimes way better than market neutral strategies also, right? But then risk is really high. If you lose, you can lose big if you are leveraged. That's what you need to understand over here. That if you're wrong, then you can lose. Think about somebody who bought Facebook probably 2 months ago, right? The stock is down more than $100 right now because it was a directional trade. You expect it to go higher. Now, uh, similarly, if you choose the direction wrong, then the risks are much bigger. Now, there are, as I said, a lot of investors, that's why they switch to market neutral strategies, right? And if somebody wants to invest a large sum of money, so what is the large sum of money? This is really important. So, guys, use your chat options. Tell me, according to you, what is a large sum of money? And that has nothing to do with, so, I mean, I wouldn't know how much your income is, or I don't want to know. But what do you think, as for you, what is a large sum of money? Use your chat options. What do you think is a large sum of money? If you have to, if I tell you invest a large sum of money for you, what would be that large sum of money? I hope everybody can hear me. So I'll repeat my question. If I ask you that you get the chance to invest a large sum of money from your account, what is that large sum of money for you? Like for me, let's say it is $5 million, for example. For you, it could be 100,000, it could be 1 million, it could be 10 million. Give me that number. A large sum of money which you would want to invest, not into just speculation, something really significant. What do you think that's going to be? What is that number? Write that number. Okay. Okay. So that is good. Everybody's writing different numbers. Somebody said $200,000. Somebody said 300,000. Somebody said 500,000. So that is good, right? You think this is a large sum, and it's perspective. Money is never enough. Somebody said 100 million. Great, because money is never enough. Money can be for somebody even $1,000 is the last sum. It's the perspective. It's the what that particular amount in your mind is, how important it is, right? Now, something that important, that particular amount which is that important, you cannot just invest into a direction. I hope you're trying to understand what I'm saying. Just because you feel that Facebook is going to go higher and you have a direction in your mind, you can't invest that large sum of $100,000 or $100 million into Facebook, right? That becomes a directional trading. If it goes well, you make a lot of money, but if it goes wrong, then you lose big. That is where the market neutral part comes in. Now, this is where we try to understand market neutral is this concept where you as an investor will take a buy position and you will take a short selling position, probably in the same asset, or let's say a asset which is just two assets which are very much complementing each other or are very opposite of each other or are each other's buy product, but you buy one and you short sell another, right? Now that difference, there is a difference. The difference can be it. So for example, let me give you an example. So when I say, and use your chat options for this, when I say Pepsi, which is another company which comes into your mind? When I say Pepsi, just like Pepsi, which is that another company that comes into your mind? Very close to Pepsi. You will go to a restaurant, you will ask for a Pepsi, and probably the guy says, I don't have Pepsi. What else you would ask for? Okay, you got one option. Surprisingly, I won't be surprised if the answers are very similar to this. It's a very common thing. So a lot of you said Coca-Cola. Somebody did say Sprite, to be fair, which is to be fair, of course. But yeah, when I say Pepsi, the next thing which comes into your mind, the very much related company, is Coca-Cola, right? Two very close products. They target the same market. They have the same regulations. They face the same challenges, right? So now think once again, just like this Pepsi Cola. When I say MasterCard, which is the immediate next company comes into your mind? So when I say MasterCard, which is this another company that comes into your mind? You don't probably even have to. You don't even have to think. I guess it's just right there because we have just heard these two companies and nothing else, right? Obviously. So answers as again similar. Visa, right? Somebody wrote Visa, but will prefer MX, of course, MX also. But then, if whenever we talk about Mastercard, the other company which comes into the mind is Visa. Why? Because both of the companies are so common, and they are exactly the competitors. They target the same market. They look at the same area. They face the same challenges. Now that's really important. They face the same challenges. Be surprised to see that even their price movement. So just like this, there are pairs like Ford and General Motors, Pizza Hut and Papa John's Pizza, like that, for example, right? The same market. Now, what market neutral strategy would be to buy, and I'm giving you just an example right now, buy MasterCard, short sell Visa. Now, when I say the word short selling, and this is very important for me to know, how many of you know about short selling? If you know about short selling, say yes. If you don't know about short selling, say no. And I'm going to explain it to you on a live platform that how short selling works because that is the basis of market neutral strategy. So if you don't know, write no. If you know about short selling, write yes. Use your chat options, friends. If you know about short selling, if you don't know about short selling, if you don't know about it, I'm going to tell you something really, really cool, and I'm going to tell you on the live platform how to do it. And it will just take 5 minutes for you to understand this, and then we'll discuss further on the market neutral strategies. So majority of you don't know about short selling, and that's why some of you who know, please be patient with me. I just have to explain this to make it right. Okay, I'm going to explain you how short selling works. Look at this. This is a bottle of sanitizer. In 2020, when the pandemic happened, the price of this bottle of sanitizer reached $100. Now, this sanitizer belonged to Century Financial, and I expected right now the price of this sanitizer is $100. Maybe in a 1 year's time, when the vaccine roll out, the price of the sanitizer is not going to be the same, right? Because vaccines are there and people are chilled out, so the demand for sanitizer is not going to be this much, and the prices will fall. So I thought, let's try to make money from this. So what I did, I borrowed this bottle of sanitizer from Century Financial. I was sitting in my office and I told my guys, I can I borrow this? And I borrowed this from them. Now, when I borrowed this bottle of sanitizer, that time it costed $100, but I just borrowed from them. I did not pay this, right? So when I borrowed this, I went ahead and sold it in the market. Now, when I borrow this bottle of sanitizer and sell it in the market at their market price, which was $100, everybody, if you have a notepad like this, or if you have notepad of any kind, just write plus $100, because the price of this bottle of sanitizer was $100 that time. So I borrow this bottle of sanitizer and I sell it in the market. I got $100, and then I waited for entire 1 year for the vaccines to roll out, because this bottle I borrowed from Century, I had to give them back, right? So I sold it for $100, and then I waited. I waited till the price of this bottle went down from $100 to $10. And the moment the price came down to $10, I took the $100 which I had with me. I went back to the market, bought the same bottle, but this time not for 100, just for $10. So I come back, I give back the bottle where I borrowed from, and keep that $90 difference which I have. Now I'm going to show you a live example of this on a live platform, so that you can clearly understand that how short selling works in the live market. See, I have opened right here. This is the Facebook stock price. See how much it has come down right here. I hope everybody can see this. My picture is here. Sorry. So look at this. Let me reduce the whiteboard. Yeah. This is the dip in Facebook right now here. Oh, sorry, I just removed orange. Yeah. From here, it went down here, and it's still trading around here. The highest somewhere around this side, and right now it is here. Now let's try to understand that how you could make money from Facebook while it was going down. Again, guys, it's a hypothetical situation. So let me show you how this would work. Oh, sorry. Yeah. Now, let's say I want to short sell Facebook. So short sell is the process of borrowing the instrument so instrument means borrowing the stock from the broker and selling it live in the market. And when I say selling it live, the first thing comes into your mind, that how can I sell something which I don't have? How did I sell this bottle of sanitizer which I didn't have? I borrowed it from someone, right? Similarly, you borrow the stock. So just see right here. What I'm going to do, I'm going to borrow 100 shares of Facebook and click here on sell. and I place a sell order at 221. This is the selling price, and I just sold. It says you sold Facebook shares or Meta platforms, you sold Facebook shares. How did I sell Facebook shares which I didn't have? I borrowed it from the broker and sold it for $221. Now, this is a question to those people who said they didn't understand the short selling. Tell me if you have a notebook or if you have a notepad, when I short sell Facebook shares, I borrowed it from the broker and sold it in the market. Okay. Now, when I sell Facebook shares in the market, the share price of Facebook is $221, and I borrowed 100 of these shares and sold into the market for 221 each share. How much money will I get when I sell 100 shares of Facebook at a price of 221? What is the total money I will receive? Write it on your chat options, especially those who said they didn't understand the short selling. I want you to understand this. If I sell 100 shares of Facebook at a price of 221 each share, how much money will I receive? Everyone, I want equal, complete participation in this. Trust me, once you understand this, it will be a piece of cake for you to understand market neutral strategies. Everyone. So, okay, great. A lot of people have started applying. So when I borrow 100 shares of Facebook and I sell it in the market at $221 each, I will receive 22,100, right? How did I did? 221 one share, I am selling 100 shares. So how much money I get? I get 22,100. Now what you need to do in your notepad, write plus 22,100. Because this is the money which you have received. And how have you received this money? You sold Facebook shares. How did you sell Facebook shares? You borrowed from the market, and so you borrowed from your broker and sold it to the market. Now, tell me, if the Facebook price from 221 comes down to 211, from 221, it crashes to 211. And you buy back the Facebook shares from the market at 211. What is your total profit? Total profit, not profit per share. What will be your total profit? If you buy Facebook shares at 211, okay. So if you have your notepad, you had 22,100. Now, if it goes down to 211, you're going to buy them back. How will you buy them back? From the money which you have. So from 22,100, how much you're going to give? You're going to give how much? 21,100, right? Because 211 into 100 shares. So from 22,100, you give 21,100 and you are left with $1,000. How did you make money? You made money from the falling markets. What it is called? It is called short selling. Is it a very new concept? It is not. Do many people do it? A lot of people do it. If you right now on Google search short selling, you will find hundreds of videos. But a lot of these things we don't know. And that's why this session is conducted, to make you understand that how these kind of things work. So when you're expecting prices of something to fall, instead of buying, or instead of waiting for them to come down so that you can enter, you can take advantage by short selling. But that being said, it will again be a directional trading, right? So when I was telling you, a lot of investors do directional trading. If they're expecting the stocks to go up, they will buy. But if they're expecting the stocks to fall, then they will short sell. What is short sell? What I just did. I borrowed from the broker, sell it in the market, and when the price comes down, I buy it back and give the stock back to the market, but keep the price difference, what I just did. If you still didn't understand how short selling works, we'll have a one-on-one session and I'll explain you once again properly. But for now, I'm considering a lot of you have already understood. Now let's switch back to understanding what this market neutral strategy is all about. Now we talked about Pepsi and Coca-Cola, Mastercard and Visa, Pizza Hut and Papa John's, Ford and GM. What is one thing which is very common between these two companies? They have a very similar product, they have similar target market, they face similar challenges, and you will be surprised, this price movement is almost the similar. So while we are on the platform, let's just see uh, Pepsi, for example. Okay, this is Pepsi and Coca-Cola. So looking at 10 months. So this is Pepsi and this is Coca-Cola. Coca-Cola had a big fall when Ronaldo removed the Coca-Cola bottle from there. But if you see them, look at the prices of both of this. This is Pepsi price and this is Coca-Cola, right? Similarly, if I show you MasterCard, this is MasterCard, and then I'll show you Visa. Look at this. Sorry, let me just look at MasterCard, 10 months. Sorry, let me make it 10 months, or let me make it 1 year and make MasterCard also 1 year. See, MasterCard, Visa. I mean, it is never going to be a very striking resemblance, but you understand what I'm saying, right? Look at the other half of it. Most of the time, when the ups and downs happens, look at the peaks and the troughs. It is almost the same. Now, what I'm trying to understand is the price movement in so much that if this is MasterCard and this is Visa, and just look at my hands very carefully, if this is MasterCard and this is Visa, and they both are moving in the same direction, uh, let me switch on the whiteboard and show you here. Hope everybody can see this. Okay. Now let's say right here, this is let me just try. Okay, just 1 second. Let me do a live demonstration of this. Okay. Now let's say if this is MasterCard and this is Visa, and MasterCard prices went up and Visa prices went up higher. Now something happened, MasterCard went up and Visa went down. Now you see this gap happening, right? This. Now this is where a market neutral strategy would happen. Because something which has always been like this, but all of a sudden it happened like this. This is where the arbitrage happens. This is where the market neutral strategies, the opportunities come in. Because something which has gone up and other pair has come down, but these pair are so similar together that eventually their prices diverge, or sometimes they converge back. So whenever they diverge, they come back and they converge. So the idea is whenever there is this divergence which is happening, you short sell the one which has gone up and you buy the one which has come down, expecting this divergence to reduce and once again become normalized, right? This strategy is done by a lot of hedge fund managers, a lot of proprietary trading firms. They are doing these kind of strategies, and there is a reason behind this. And what is the reason why we call it market neutral, or basically what is the idea? It's not a risk free strategy. Okay, there will always be risk in every strategy, but the whole idea of having or doing a pair trade or a market trading, because there is always a divergence which happens between two asset classes, And these divergence can be related to short-term events, earnings, or anything like that. But then when that divergence gets corrected over time, then the difference between those prices, that's where you make money, right? And at the same time, what also happens is during this time, you do not care about what happens to Pepsi or Coca-Cola individually, because you are betting on the difference between their prices. So this is normally how, and I'll explain it to you on the live platform, that how do you take this trade and use this strategy. Just try to understand one thing at a time, that you buy one and you short sell another. Now you know what short selling means. Short selling means when when you try to make profit from the falling prices, right? Buying means when you're expecting prices to go up, so you will be expecting to make profit from the rising prices. So this is when you buy and this is when you short sell. Now let's try to understand some strategies like this. So let's go back here to the, okay, okay, this is my presentation. So there are two kinds of market neutral which normally happens. One is fundamental arbitrage, another is statistical. Statistical is mostly with numbers, and a lot of strategies you will find will be statistical, very less fundamental. There are different kinds of strategies. There is seasonality, pattern, and price action also, which I will tell you. But for now, let me show you first of all how a statistical arbitrage will happen. And the most important of this is a pair trading. Okay. Now, guys, once again, this session is not to confuse you, but I'm just going to discuss one or two strategies, discuss a couple of portfolios, and then I'm all in for a one-on-one session with all of you for you to help and understand this clearly. Okay. Don't, after this session, just open an account and take this. Take your time, spend some time with your consultant and understand how this works, and then we'll do it together. Now, let's understand the very first strategy, which is on oil, because pair trading is one of the most important statistical arbitrage, a market neutral strategy. It's a very well known example, and it's very simple to understand a market neutral portfolio where you have one buy position and one short selling position on oil. So let me just open this for you. Now, guys, there are two kinds of oil. Tell me how many kinds of oil, which are the two kinds of oil? Anybody can use your chat option and tell me. What are the two kinds of oil? The most commonly used, there are two kinds of oil. Which are those two oils? I know it's a very forced participation. I keep telling you to do this again and again, but I really want you to be interested into the session. And this is really going to help you understand a lot of things. So even if you're bored right now, do not worry. Just be with me for another 30 minutes and you will find this session really, really worth it. So which are the two kinds of oil which are commonly traded on the exchange? Name them. Okay. Okay. I've started getting answers. Okay. Right. Right. Perfect. Perfect. Okay. And there are a few of you who haven't answered yet. Just try. Tell me, what are the most common oil kinds of oil which are traded on the exchange? Answer is right in front of you, but I want you to write it. That is how you will remember. That's why I always use a notepad. This is not one of those webinars where I come as a background voice, say something, and then leave. I really want to make a change, and that's why we do these sessions every week to ensure that the concept is clear to everyone, and then we always follow up. So this is a completely free of cost thing, and I want to keep it that way. So that's why I need more and more participation, more and more support. So come on, guys, tell me which are the two kinds of oil which is most commonly traded. I've received a lot of answers. I just want full participation here. Right? Okay. Okay. Okay, perfect, perfect, great. So a lot of you answered uh, correctly. Some of you answered uh, oil, crude oil. So crude oil is the asset class. Okay, crude oil is the asset class. Within crude oil, there are two forms of oil. One is called Brent oil. Another is called West Texas or WTI. Now, WTI is a US based oil which comes from the US drilling, right? Brent oil, it comes from the North Sea. Now, Saudi, Russia, they are more concerned with Brent oil. Okay. West Texas or WTI is the US oil. Both these oils are traded in the exchange. Brent is the benchmark. So a lot of people will look into the Brent for the prices. It's the international benchmark. But both these oils are traded. And so how I'm able to create a market neutrality between this? Both of these crude oils, they have, so both Brent and WTI, and listen this very, very carefully, both of these crude oils have one underlying asset on which they are based. And which is that asset? Crude oil, right? Whatever price these two kind of oils are on, both prices are highly correlated and they cannot diverge very much. So for example, if one goes up, other goes up also most of the time. And that's why when the divergence, and what is the divergence? Divergence means if one goes up and another doesn't go up or comes down, that's where the divergence is, right? So as compared, so again, let's use the chat options once again, guys. If this is Brent oil and this is WTI, both are the forms of oil. And I just told you that if one goes up, another goes up. If one comes down, another comes down. Now, my question is, after knowing what I just said, do you think it is very common that one will go up and another will come down and there will be a divergence? Is divergence common between Brent and WTI? This is my question. It's a yes or no question. Is divergence between Brent and WTI common? Divergence means the opposite price difference between two oils. Is it common between Brent and WTI? It's yes or no? Come on, guys, use your chat options. Answer this. Does the divergence between Brent and WTI, is it something which is a very common phenomenon or is it not a common phenomenon? Okay, okay, right. First of all, thank you so much, everyone. Now, all of you are answering, and this is something really, really good. You're participating in this. Incredibly boring presentation from my end, but you're still participating, so that's really good. Now, so all of you are right. Of course, the divergence should not be very common, right? Because both are forms of oil. So whenever this divergence will be found, and whenever this happens, because it does happen, it's not very common, but it does happen. Now, whenever this happens, the and it can be due to several reasons. Could be because of the oil inventory, could be because of high demand, could be because of new pipeline supply disruption, right? Geopolitics, microeconomics. But whenever this divergence happens, a lot of times this divergence gets corrected. Over the time, it gets corrected. So whenever there is this big gap which opens, it's like consider like a black hole that when it happens and then it closes. So whenever it opens is the opportunity for the traders or for the investors to look into, because this divergence is expected to get corrected over time, right? And that is the reason, the sole reason behind this is because both of these oils, they have one common underlying asset, and that is an oil barrel, right? Now let's look at the flyer and understand what has been going on. Okay, now first of all, what are we going to do in this particular strategy? And let's look at the chart right here. This is the chart of Brent, June, and WTI. Okay, I'm just zooming in. Just process this chart in your mind and look at it. Okay, right here. Meanwhile, just have a look at it. Just 1 second. Right here. Just have a look at it. Look at it. Click a picture. Okay. Now I'm sure by now everybody had a good look at it. Now, what does this actually show? Yeah. Now look at this chart. This does not show the price of. Okay. Let me ask. Do you think it shows the price of Brent oil? The chart. It says Brent WTI spread. Anybody who will answer me this question on the chat. Does this shows the price chart of Brent oil, or this shows the price chart of WTI or the US oil? What does it show? It shows the price of Brent or it shows the price of WTI? What do you think it shows? Use your chat options, guys. Whatever you understand. It's not about right or wrong. It's about right now how much you can expand your creativity. What do you think it is? Does it show the price of Brent oil? Does it show the price of WTI? Think. Think about it. Okay, the few of you have started answering. That's great. It says Brent WTI spread chart, right? So this is the difference between two oil prices. Exactly. So now a lot of you are looking what you're looking at. This is the price difference. So from 2016 till 2021, 5 years, how much oil prices, both these oil prices, what has been the highest diversion in last 10 years, last 5 years, and what has been the lowest diversion? And what you see, those green dots right now, those green dots are the bottom where it picks from every time. And as you can see, in 2021, by the end of 2021 was the last green dot, and it's a kind of support from where the price gap increases. So this price gap, which is $2 right now, is expected to rebound, at least go back to $4 from where it has most of the time been. Now, every time the price difference is this much, it is expected to bounce back. Okay. So if right now the price difference is $2, let's say, so now following this, and I'm sure if I hope if you are writing in your notepad and now you'll be able to see this. Let me share my screen real quick. Okay. Now this is crude oil Brent. And this is crude oil West Texas. Right here. Look at this. There's crude oil Brent and this is crude oil West Texas. If everybody can see the screen, tell me what is the difference between the oil prices. Look at the buying price, the one which is in blue. Can you calculate the price difference right now? What is the approximate difference you can find right now? Look at the price difference right now. What is it? Tell me I mean, the closest because prices are moving, so I'm sure you won't be able to show me the price, but how much do you think is the price difference? Use the chat options, guys. Use the chat options. Calculate the differences. So Brent is 87.69 and WTI is 86.05. Both are oils, right? WTI is 86.08. Brent is 87.71. So what is the difference between both the oils? Calculate, use the difference. Tell me, use your chat options to tell me the difference. Okay, okay, okay. Perfect, perfect, perfect. Great. So everybody understands around 1.5, 1.6, right? Now come back to this chart. So why we need to understand why I asked you this yourself. So now if you see the difference between, it is almost around the lowest point, right? Somewhere around 1 point something. This was around 2 right here and went down to 1 point something. Look how high it has been. It has been high around $10. Now let's understand the fundamentals of it. Now, the Omicron variant, it came really quick, but fortunately doesn't have much impact, right? So it is basically the demand for oil should not get impacted too much. And there has been the economy of US has been opening really fast, very positive for the US economy, right? Now, OPEC and its Russian allies have the same story to narrate and appear increasingly confident that Omicron will take a limited toll on oil demand, which means oil demand is expected to grow at a steady pace, right? Now, that being said, there are a lot of factors where demand is expected to be greater or stronger than the supply, right? And that's why we are expecting Brent oil prices may continue to outperform WTI, right? Now, we need to understand this. US government has raised the oil demand forecast, but and at the same time it has lowered its oil output growth estimates also. So total demand in the US is rising 840,000 barrels per dollar per barrels per day for the year, and which is higher as compared to the last month, right? It is also expected to grow by another 300,000 barrels per day in 2023. But at the same time, the production of oil is also expected to rise. Now, this is lower than the previous month forecast, but again, this will essentially force the US to rely on international supply and build up pressure on Brent prices. So at the same time, now we are expecting over here. So what will be the rationale of this strategy that you buy Brent, expecting Brent to grow higher? Why? Because demand is expected to grow, and at the same time short sell WTI oil because supply and demand for oil in US is expected again to grow. Now, the strategy is very simple. How do you apply it on your portfolio when you are doing a market neutral strategy? This is where you get to understand the application of this. If you have to apply this strategy to your portfolio, you go to your live platform. Not just right now, but just understand if you have to take a trade. This price is dollar per barrel. Now I told you to buy Brent. So let's say if you're buying 1,000 barrels, it will be equal to $87,000. At the same time, you short sell 1,000 barrels in WTI. So this is the quantity trade, right? Same number of quantity. You buy 1,000 barrels and you short sell 1,000 barrels. You just took this trade, account, positions. Let me close this Facebook trade right now. Okay. Now see, you have $1,000, 1,000 barrels Brent oil buy and 1,000 barrels WTI sell. Now currently your loss is $100, which you bought one and you short sell another. Now the only thing is this loss, what you see right now, will only increase if Brent goes down and West Texas goes up. Only then your loss will increase. But if oil moves, if oil prices collectively go up, then we expect Brent to go higher and WTI also to go higher. In that particular case, what will happen? Your loss will be nullified because you are making profit in Brent subsequently when you are making a loss in WTI. So it's break even. Your profit will happen only if Brent goes up and West Texas goes down, which we just discussed because of the above reasons might happen, right? Otherwise, your loss will happen if Brent goes down and WTI goes up, which is less likely to happen. In both the cases, If oil prices move up and down, you don't have to worry about your portfolio, because if oil prices move up and down, most likely the Brent and WTI, they move in the similar. So if oil prices go up, then you have profit Brent, you have lost. If oil crashes, then also you have a profit in WTI because you have a short session, but you have a loss in Brent. So loss is nullified. Basically, the idea is very simple. This is the most basic strategy, because when you buy a Brent, you sell WTI. Whenever the prices diverge, theoretically, if you do short and long both, it will be the same amount of dollars on the same commodity, right? If the oil prices go up and down. But over here, what we are seeing right now is you're not playing on the oil market, right? You're playing on the difference of the both prices. So for now, just try to understand what a market neutral. So market and neutral, both words, that means we don't care about the oil market. It might go up, down, or crash. What we care about is the difference between the two oil prices which fluctuate, which this divergence is at its lowest right now, which means a right time to enter. You're expecting this divergence to increase, which means Brent will go up or this will come down, but this gap will increase. So that's why you're taking this particular trade. Now, this is very unconventional and unusual than normally what you hear from people. You will always have speculative calls, buy oil, sell oil, but this is something which is a strategy based trade I'm talking about. So this is called a market neutral strategy. Now, this is the same strategy which can not only be done between two oils. That is just one thing. This can also be done between two indices. So as of now, if you see something called as UK 100 and German technology. Now in this, what we're, again, ratio based trade, right? Just look at this. This chart again is based on the ratio. What we are saying, that UK 100, which is a UK index, you buy UK index and you short sell German tech index. Why? Because UK 100 maximum majority of weightage is given to consumer staples, financials, and healthcare, industrials, and energy, which is value sector, value based companies. German tech has 46% towards IT technology. And I told you in the beginning that in a high rate environment, tech stocks come down and people move towards value companies which are giving good dividends. Plus, if interest rates go up by the central banks, UK banks, even if globally interest rates go up, UK is the financial hub. So a lot of UK banks will get benefited even when there are rate hikes in US, right? So that's why currently the strategy says you buy UK 100 and you short sell the German tech index. Look at the ratio of, look at the spread right now, right here. If you see extreme right, how this ratio has come up. So this ratio has come up. If you see the German tech and if you see the UK 100, you divided the prices, that's how the ratio comes up. Okay. Now this ratio is at its almost very near to at its lowest. The lowest was 0.7. Right now the ratio is around 2, but this ratio has been around 10 also. So again, expected to go higher. If we see fundamentally, then we are looking at UK 100 prices to go and outperform the German index. Why? Because German index has maximum weightage in tech and UK 100 has maximum weightage in the value sector, the sector which is preferred a lot right now, right? This is one more kind of pair trade which you can look at. Now, apart from this, there are strategies which are related to seasonality. Uh, Now, seasonality strategies are slightly different. So, how seasonality strategies would work? Let me show you. So, this is almost the end of this session. I'm explaining you all these strategies right here. Look at palladium. So palladium it's a metal which is probably used in your cars as a pollution filter. Okay. Um, See, pre-COVID, around 2018, palladium accounted for 85% of pollution reducing catalytic converters in gasoline engines. So the demand has been increasing amid supply restrictions. In 2021, the increase in the prices kind of stalled because there was a shortage of the semiconductors, right? At the same time, a lot of technical advancements also happened, which where people started utilizing platinum as a less expensive converter. So we have seen palladium prices slightly coming down. Now, strong gains throughout palladium. It still has dropped around 30% in 2021, right? Now, if we see that this decline of 30%, which we have seen, now in 2022, we're expecting a recovery in the car sector, which might boost the demand for this particular metal. It has been used before in a lot of cars, and the prices have gone up. Russia and Ukraine, there are also a lot of tensions going on, so there can be a reduced supply because Russia produces around 40% of freshly mined palladium, right? Which you can see right now in this particular flyer. So all these kind of things, they're expecting palladium prices to grow. Now, that being said, let's look at the seasonality part. Now, what we do in the seasonality part, what a seasonality strategy is, we start looking at 20, 25 years of performance of a metal month by month. So, what you see right now is that we have picked February as a month where most of the time palladium prices have shown positive results. And when I say positive, that means the highest it has gone is 46%, while the worst performance, which is seen in February, is around 7%. Oh, sorry, 20%. So the idea of a seasonality trade is very simple. You look at the last 20, 25 years of a product, whichever you are looking at, and look at the month on month performance just to see that which month has the maximum favorables and maximum return generated and what is the maximum loss throughout. So right now, in the case of palladium, in last 20, 25 years, February has been the most profitable month where we have seen 46% the best high in 1 month and 20% the worst which we have seen. So in last 20, 25 years in February, palladium has not fallen down more than 20% and it has gone up as high as 40, 45%. So if you're taking a seasonality trade, you have your risk and reward in mind that I'm taking a risk of 20% and I expect to make a reward of 40%. So you at least know your drawdowns, and that's how a seasonality trade would work. Now, this is seasonality is possible in crops, agricultural commodities like rice, wheat, sugar, coffee, in base metals like palladium, and then precious metals like palladium, platinum, gold, silver, etc. So these are called seasonality based strategies. Guys, why I'm telling you this? Because this is a very unconventional form. Not all the time you get to hear these kind of things. You can all these, and the worst part about this is it's very common, but we are always told the same speculation, buy, put a stop loss and everything. But this is strategy, right? This is quant based strategies done by a lot of hedge fund managers, and that's why we are discussing this. Now, before and the last thing which I want to discuss with you is a recently made ladder portfolio, and this has been created looking at the current market decline. So if you're an investor, if you're not an investor, just keep a check on these stocks, click a picture if you want, and I'm sharing this ladder portfolio with you right now. It's not a market neutral strategy, so just let me show you this. It's not a market neutral strategy. It's just a current ladder portfolio which we have prepared, and we are sharing it with a lot of clients. So perhaps have a look at it. The idea, this was prepared for clients who wanted to invest around $500,000, but the idea is very simple. This particular portfolio, the investment should be in ladders in different phases. So let's say, for example, if you have $100, you invest $40 now, and then phase two, invest another 35, and then phase three, invest another 25, and then that's how you invest, not buy at once. A lot of clients came to us and asked for this, that how do we allocate? So this is the portfolio which we are looking at, where there is a mix of aggressive technology-based companies, then moderate risk financial companies, JP Morgan, Bank of America. Then there are some companies like Starbucks, Walt Disney. So there is energy, there is entertainment, there is financials, and then there is consumer utility in the moderate, and then in the conservative one, which is less riskier, Procter and Gamble, CVS Health Corp, Coca-Cola, Walmart, Verizon, companies which gives you good dividends also. So this ladder portfolio is a mix of conservative moderate, like medium risk and aggressive risk as well. The idea is very simple. The what will be the investment style? This is for a $500,000 client, but anyone more, if you have $100,000, you do allocation according to it. Phase one, invest 40%. Phase two, invest 35%. Phase three, invest the remaining 25%. Right? So phase one, when you are investing 40%, and this is the first column, everybody, I want you to look at the first column right now, the first column where you invest 40%. So this is a $500,000 worth portfolio. So 40% will be 200,000. Out of that 200,000, 30% you put into these aggressive companies, which is Adobe, Nvidia, Estee Lauder, Salesforce, Amazon, Airbnb, Boeing. 35%, which is 70,000, 35% of 500,000, which is 70,000. You invest into JP Morgan, Bank of America, Starbucks, Walt Disney, Exxon, and mixture of this into some indices like S&P, NASDAQ, and the small cap index also. Then followed by a conservative, which is 35% of the remaining amount into Procter & Gamble, CVS Health. And like this, you will do phase one, phase two, and then phase three. So you don't have to invest everything at once. You just have to wait for the right entry. So phase one, because markets fell right now, so a lot of investors would buy now for the phase one, where you put 40% of your equity. Phase two and three should be done at the right support levels. What are the support levels? Support levels means price, the support level from where maximum number of times the price bounces back, right? So maximum number of times the price bounces back from this particular level. So if price comes down and bounces back from here, then this becomes your support price, right? So you should enter over here for your phase two and phase three. So these are some companies which you can look at. And as I said, this is a very complicated subject, guys. I mean, each one of you, I have not seen one person exiting from my session in last 1.5 hours. So this is something which is really amazing that all of you have stayed and listened to me. I know it's a very, very complicated subject to talk about market neutrals and ladder portfolios. Nobody dares to do it mostly on the webinars, but then you have been such a responsive crowd. And that's why all of you are allowed for at least 2 one-on-one sessions with me. If you want to understand more about this, learn the platform, discuss the ladder portfolio, discuss market neutral strategies, understand the risk and reward, right? There are a few questions over here about can we get the demo accounts? Yes, you can get the demo account. You can talk to your relationship manager and they will give you the demo account also. When are you free for a one-on-one session? Definitely. Now we are working Fridays as well. So Monday to Friday, anytime you want to conduct, whether you want to come to the office or you want to do it on Zoom, I'm available for a one-on-one session as well. Can you send the bond ladder? Can you send the ladder portfolio, the stocks ladder portfolio? Yes. Just find out the person who connected you to this webinar and tell them that we need the ladder portfolio which is discussed, and we'll definitely send it to you. So do not worry about that. Okay. Perfect. So that's great. Amazing, guys. Thank you so much. Before I end this session, a big vote of thanks to anyone who is connected to the healthcare, pharmacy, or that line of work, first responders, doctors, midwives, and nurses who have risked their lives every day during the pandemic. There is no other way to appreciate this behavior. You all are above everyone. So big word of thanks on behalf of my family, my friends, my team at Century Financial. We owe you our lives, and thank you so much for doing what you're doing. If you are one of them, thank you so much. If all of you are connected to any one of those, your friends, your relatives, your spouses who are doing this, my big vote of thanks to them, and I really appreciate the work they do. I really appreciate the work you do. I hope the pandemic goes away real soon and life gets back to normal. Till then, let's continue to do more of these sessions, and we'll definitely meet once again next week with a different topic. Till then, for one-on-one sessions, contact me. My name is Yogesh. If you like this session, please go on Century Financial Google reviews. Give us a good review, give your feedback about the session. if you like the session, if you didn't like the session, this is something which we do free of cost, and we want to keep doing this in the same way, discuss more and more strategies. So thank you so much once again, guys. If you have any questions or queries, I will be available on call or over WhatsApp or emails, and for a one-on-one session as well. So once again, you have a great night. Thank you so much. Be safe.